Everyone, hope you're doing well since the last time we chatted with you. My name's Drew Creekmur. For those of you who don't know me, I'm the Director of Advisory Services here at Creekmur Wealth, and I'm joined by John Creekmur, our founder and Senior Wealth Advisor. And today we are going to sprinkle in some good news and some interesting data that we are tracking that's kind of informing how we're making investment decisions here internally at Creekmur Wealth. But John, before we hop into that, how you doing today?
Drew, I'm doing great. Good start of the year. Obviously, it's hard to believe we're already middle of February. Survived Valentine's Day. It's a good thing. I didn't forget the holiday. If you're in the doghouse at home, you forgot Valentine's Day, do something special. Definitely call the office. Let Rachel know. She'll put it on the calendar next year to give you a call so that you won't forget. And so we always kind of got each other's back that way. But yeah, so doing well, Drew. Doing good. It's been kind of a mixed year as far as with news. It seems like what's good is bad, and what's bad is good. So I think we're
Right.
going to dissect a bunch of that today.
Yeah, we are. And I think you hit it on the head. We've had a good six first weeks here of the year in markets, seeing very strong positive returns. But a lot of people are actually interpreting that as bad news
Mm.
because it's showing that the Federal Reserve's actions to bring down inflation are not doing enough. And so, John, we're going to kind of parse through some of the market data that we're watching and then go and talk about inflation and what that means for the Federal Reserve. And, we have a chart up here on the screen. There's a lot of stuff going on. But there's three main data points that we're watching. And so there's two colored lines on this chart. One's blue, that's the 50-day moving average of the S&P 500. The other line is orange, which is the 200-day moving average of the S&P 500. And we look at this chart every single day to track the momentum of the market and to let us know, hey, is it a good time to be in all the way, or do we need to maybe pull back on some of our exposure to the market? And what you'll notice on the left-hand side of the chart, in about the middle of March of 22, the blue line, so the 50-day moving average, crossed below the orange line, the 200-day moving average. And this is what's known as a death cross in the technical charting world. And typically this signifies that there's downside in the market coming in the months ahead. And we saw that play out throughout the last 3 quarters of 2022. Well, if we go over to the right-hand side of the chart, you'll notice that really at the start of February of 22, the blue line, the 50-day, crossed above the orange line, the 200-day moving average. And this is something known as a golden cross. And this is a sign that the market is gaining strength and that there is strong potential for some solid market returns in the months ahead. And the other thing I'll point out around that January through February of 23 is we actually saw the market break out above the 200-day moving average, which had not happened in over a year. And typically, for strong market returns to continue, for strong momentum to be in the market, you need the market to be trading above the 200-day moving average. And so, John, we're seeing a lot of positive movement in the market. And how should we interpret this particular chart?
I'll tell you what, it's a great chart to look at. And so when you think about a 50-day moving average or a 200-day moving average, what is that really? And so a 50-day moving average, that's when you take the closing price of an index or an individual stock every single day for 50 days, and then you add all those up and divide by 50. Well, that's your 50-day moving average. The very next day, now you have a brand new data point for the most recent daily occurrence. The 200-day moving average is the exact same process. However, you take the closing price over 200 days. So the reason why it's significant is if you see the 200-day moving average, that's more of a longer term trend line. And if you see the 50-day moving average crossing it, either on the way up or the way down, that means the most recent momentum all of a sudden is showing a positive or negative period of time. And it's being really kind of told to say, whenever you see that, it does kind of give you some confirmation points for what's going to happen broad based in the market. If you remove outlier events, such as let's say a September 11th is an outlier event, or all of a sudden, let's just say we happen to see an attack on Russia and Ukraine, an outlier event. So outlier events do affect things. But whenever we look back over things, whenever the 50-day crosses the 200-day on the way down, that's called a death cross. And whenever the 50-day crosses the 200-day on the way up, that's called a golden cross. And if we look back over the course of time, there have been moving average golden crosses that happen at different points of time. There have been 37 golden crosses. And again, Drew just said we just had one of those here about 2 weeks ago. But there have been 37 of those that have happened in the S&P 500 since 1950. And of those 37 times that it happened, 78% of the time, or 29 of those times, the market had been higher 1 year later by a median increase of 12.7%. Now, whenever we take that golden cross and we actually say, let's add one more factor to it. Whenever that happens, at some point during a recession, everything all of a sudden tightens up. So whenever that's happened, it's actually happened 20 times since 1928. We've had a golden cross during a recessionary period of time. And most economists believe that we are either in a recession or we're going to be entering a recession here in the next quarter. Well, we know we've seen it happen 20 times before. And of those 20 times that it's happened, 74% of the time, the stock market was higher 9 months later with an average rate of return of 14.1%. So now we can't say that what happened in the past is going to absolutely happen in the future. However, we do know coming off of a year in which the S&P 500 was down by over 19.6%, and we take that all of a sudden we hit a golden cross, and people believe the Federal Reserve is getting close to the end of their interest rate tightening or raising of interest rates. Those are all signs that we could be seeing some more positive move in the stock market here in the next 9 to 12 months.
Yeah, and John, I think we're going to put a chart up here that shows returns from 1970 through 1985 of the S&P, which is really one of the most similar time periods in our country's history to what we're living through now. We had high inflation, we had a lot of economic concerns, but there's a few years that really stand out to me. There's only been 4 times in history where the S&P's been negative in back-to-back years, and one of those times actually occurred in 1973 and 74, where the market was down 14% in 73, 26% in 74. But the thing that's interesting to me is to see what happened in 75 and 76. In 75, we were up 37%. In 76, we were up 23%. So we know history doesn't repeat, but it does rhyme. And with what we're seeing in this technical chart here that John just walked through, and looking at past periods that are similar, we do think there's a strong potential for some positive type of return in this year. Now, John, one of the things, though, that we know is that this week earlier, inflation data did come out that showed that year over year inflation was slightly higher than what was expected. And right now, everything in our economy and the markets revolves around inflation and what the Federal Reserve is going to do about it. And last week, or the last time we did a deep dive video, John, you talked about sticky inflation. And so we're going to toss a chart up here that actually shows the past reporting periods of different types of inflation, of different types of components that make up inflation. And the one that you're going to notice is the dark blue bars down at the bottom of this chart. They're going up and to the right, while everything else is coming down. And John, that's services, or what you were talking about, sticky inflation. So when we look at this chart and really the big picture with inflation, how do we interpret this? What do we make of this?
Yeah, so inflation, it does move in different cycles. And so sticky inflation by definition is inflation that once it hits, it generally does not come down, it sticks. Now, some inflation would not be sticky. So let's say an event-driven inflation. So we all recognize what happened if you happen to eat eggs. We know in November and December, the wholesale price of eggs went up by 100%. And then the retail price had a corresponding increase in those 2 months. Well, why did it go up? Well, there was a bird flu that killed a large majority of the hens, the layers of the eggs. And so all of a sudden there was a lot fewer eggs out there. And so all of a sudden the price went up. But we know since the last 3 weeks, the wholesale prices of eggs have actually decreased by 50%. Now, it's not fully trickled its way down into the retail. I did see that eggs had come down about 25% the last week here in central Illinois. And so we know that would not be an example of sticky inflation. So what is sticky inflation? Well, sticky inflation would be, let's say, services is a great example. So what are services? Well, that would be actually like airfare. That's a service. That would be also like going out to eat at restaurants. That's a service because we know the cost of certain of the ingredients that they make have gone up, and they typically will not be coming down rapidly. We know that whenever we see the pricing as far as for wages go up, and so whether it's a minimum wage or whether it is simply sort of tips, whatever it may be, when the price of wages go up, those do not come back down. So that is therefore sticky. So the things that we're seeing that are more problematic from an inflation standpoint is that we are starting to see relief in certain areas through the month of January. However, the areas that we call sticky are things that will be with us now forever. Those prices have not come down at all, and actually is actually moving a little bit as far as the momentum to the upside. And so that's something we keep our eyes on over the coming months.
Yeah, and since that report has come out on inflation, we've actually seen the bond market has begun pricing in a higher expected federal funds rate, so higher interest rates, is now being expected. And we know that everything right now is really saying, hey, what's the Federal Reserve going to do? And John, why is a higher for longer mindset, and that's kind of where we think this is going, so higher interest rates for longer, why is that important, but also not something that right now the market really seems to be caring about as it continues its march upward?
So right now the market is in a little bit of a relief rally, and so what we're seeing from that is what we mean by that is that things were so negative last year, and there was so much uncertainty that we got to a very low point, and so it actually lowered the level of risk to enter in some high quality names that are out there in the stock market because the price was so much lower, and so there was not as much downside as what there is potential for upside. One of the things that's problematic, though, is when we have interest rates that are at a higher level, but it's for a longer period of time. In time, what that does, it really affects the ability for companies to expand and to increase their level of earnings or to have any visibility on how their earnings are going to grow in the future. We also know that our economy and the global economy is actually triggered and driven based upon consumerism. And so, in other words, the things that we purchase. And so whenever all of a sudden people have a higher expenses due to interest costs, either from their home mortgage or from their vehicle mortgage or their credit card debt, well, then all of a sudden then they'll have fewer dollars to be able to use to buy actual goods and services in the economy, which would stimulate growth. So for long term, for short term, we can see a short term increase that we're not necessarily all that concerned about. And that was some of the relief rally actually in January was tied to the fact that people really believed that we're going to see the Federal Reserve potentially lowering interest rates in the third or fourth quarter. But as inflation results are coming out from January, it's kind of showing that rates at some point will probably stop. We really are forecasting at potentially at least another one, if not two, quarter point increases here in the next 6 months. But it could get as high as 5 to 5.5% from the Federal Reserve, which would be, again, an additional 1% higher than we are now. If that persists for a long period of time, that does have impact on long-term growth in our economy, or the phrase GDP. And that is problematic for companies making earnings. And we all know stock prices ultimately move based upon the earnings of companies.
Yeah. And so, John, I know this is a ton of information we've covered here. We got some good news about the movement of the market. We got some, more cautious news about inflation and what the Federal Reserve is going to do about it. I think a lot of our clients would say, okay, we really appreciate that, guys, but how are you walking through this inside of our accounts? How are you positioning things? What's your thought process? So can you just high level it for us? What are we doing as we move forward into the months ahead?
I'll tell you what, the key thing to think about is 3 words, all begin with S: smart, structured, and systematic. As it relates to portfolios, what we are doing is we're actually saying, let's make smart moves that are systematically analyzed and the execution is structured. So whenever we see changes in interest rates, we are then evaluating what is the risk of interest rate and based investments. What is the risk of fixed income? What is the risk as far as on option-based strategies? And also, what is the risk to individual stocks, both on the growth and also on the income side? From there, we walk through the process of evaluating how do those each individual asset classes and specific companies, how do they actually move historically during similar periods of time? And then what is unique in this environment? And so what we're doing is continually evaluating what has momentum, what does not have momentum, and then what are the things that are performing best right now. And we're seeing some areas such as healthcare, such as materials. We're seeing areas such as infrastructure and industrials doing extremely well. A lot of those companies are in the small and mid-cap value space, and so you're seeing rotation within your portfolios in those areas. And why industrials? Why industrials? Why infrastructure development? If you remember back in May of 2022, we had a $1.9 trillion infrastructure bill that was passed. Those dollars are finally starting to get put to use as far as in either roadways or as far as drilling underground to put wiring underground or in bridge construction. And so whenever you see that those dollars are starting to come out into the economy now, and the companies that are tied to those industries are the ones that are doing better right now with the best momentum. So remember, keep in mind, structured, systematic, and smart. That's the way that we're approaching portfolios.
Awesome. And John, just to wrap up here, we had a conversation in our investment committee about lessons from past market periods that were really rough. I know you've managed money and worked with clients through a number of these, 08, 09, 2018 was another one, the dot-com bubble. So we're talking about 08 and 09 because it's really the second largest bear market in U.S. stock market history. talk about some great lessons that we can take away from that and keep in mind as we move forward into the year ahead. And so, what are just for you your top 2 lessons that you learned during that time period you think are really critical to just have in mind as we move forward?
I'll tell you what, I'll do one. How about you do one? The ones we talked about, okay? And so I'll say the one that really hits my mind at probably the highest level is that whenever things happen, people have a tendency to forget it quickly. And so 08, 09, and 10, we actually saw the market drop, and we saw it go high to low, close to 53% decrease, 37% in 1 year. People were lamenting that. And then all of a sudden, then the lessons that they learned in that period of time, very quickly, they forgot them. And so the risk that they took, so many folks were inappropriately invested in risk assets that did not match up with what their goal objectives in their portfolio were. They were taking more risk. They didn't understand the level of risk that they took. But then all of a sudden, whenever we get past 3 months, 6 months past the bottom, they started leveraging up or risking up again, adding more risk to their portfolios. And then whenever the next leg down came, they actually had a double whammy. And then all of a sudden their accounts were down again. And what did they end up doing? They ended up pulling the money out of the marketplace, missing the largest portion of the rebound. And so they did not learn to properly assess risk in their portfolios. And we see that, I've seen that happen time and time and time again, whether it be 2000 and 2002, whether that be 08 through 010, whether it be 2018. And the thing about right now, folks, is we just came through a period in 2022 of extreme shock in the stock market, which is down by 20% on the S&P and roughly 35% on the NASDAQ. Make sure that you do not react now that we had a huge January and all of a sudden take on too much inappropriate risk.
Yeah, I think that's huge for everyone. I know all of our advisors are talking with their clients about each of those aspects. And for me, the big thing that I really took away was that things that have never happened before tend to actually happen more than what you think. And if we look at 2022, we had a couple of things that have never, ever happened before actually happened. We had the worst year for bonds in 250 years. A lot of people, academics, would have said they never would have expected that. And we also saw the Federal Reserve raise interest rates at the fastest pace in history. And so those are things that no one could expect. However, how you react to them, how you think through things logically, like John said, the 3 S's that we focus on, that is so key to be able to navigate something that's never happened before, something that was never expected, and to do so well. And I think a great example for us was back in 2021, we started having some concerns about inflation due to how much money was being printed and put into the system. And so we rotated out of bonds in our client portfolios, and we used buffer or target outcome funds that really last year did phenomenally well in comparison to both the stock market and bonds. I know I was talking with a bunch of my clients yesterday about this, but we were able to protect a significant amount of our clients' principal that would have been in bonds if we had not followed that 3S system. And so for me, it was really important to recognize, unexpected things happen. That's never happened before. And so always have a plan in place and have a great team behind you, which we do here at Creekmur Wealth. And so, John, I know those are our 2 lessons. Why don't you send us out here today with one final thought, and we'll get everyone on their way.
I'll tell you what, everything begins and ends with a plan. And the beginning of the plan is actually being able to talk about what is the goal objectives you want to accomplish, what are your hopes and dreams. And we know that the markets change, they churn, they burn, they go up, they go down. The reality is your investments and the action steps you take should be based upon logic and wisdom that help you accomplish goals. Folks, if you've not thought about your goals recently, put your investment statement aside, take a step back, write down those goal objectives you want to see accomplished, and then start the discussion with your advisor from that point.
Awesome. So, guys, thank you for your time. If you have any questions for us about what we talked about today or about a video lower down here where I talk about how we can help you manage your retirement plan, which is your largest asset, your 401k, your 403b that is set aside for your retirement, we would love to talk with you. Don't hesitate to reach out and schedule a 15-minute strategy call with John, myself, or one of our other advisors. So thanks for your time, guys, and we'll talk to you soon.